Yeah, maybe you should re-ask there, Nancy, if they didn't hear it.
Yeah, I got it. It's about reps and warranties. It says, I
Yeah.
mean, they ask, where do reps and warranties play into the process, and how effective are they? What are its limits?
Mm.
Right. And here's the thing. I mean, with reps and warranties, I'm reminded of an example, where a buyer, they're buying a company, and this is, many years ago, they didn't feel due diligence was really necessary. What this company did is it would fill cylinders, so in other words, with gases, they'd go pick them up, maintain the cylinders, fill them, refill them, drop them off. So they had a major customer, about 30% of their business. That was there. And, talking to the person in passing, I kind of said, hey, is there a contract? Is there something, where you're sure that this revenue is going to recur? And so this person brought it up to the seller, and the seller said, oh, are you kidding me? This has been going on for 20 years. Of course it's going to continue. You're not going to have any problem at all. Well, what happened post-closing was, this buyer found out not only was this major customer no longer with them, but they had left months before, and so this buyer was left with a lawsuit, basically, against the seller, because it couldn't survive without that 30% customer. And the whole difficulty with lawsuits, and no offense to any attorneys on the call, but in the end, unfortunately, the only winner usually is the attorneys. It's not the parties that are involved. So, you may win. In certainly in this case, I'm sure this person, would have won and would have been in the right. But in the end, it just costs so much to go through litigation. And not only the time, the effort, the aggravation, it really ruined his acquisition plan. This is something that he could have seen in diligence. So reps and warranties, also they're very general, not very specific. You don't want to get into a bad deal, like he did. You don't want that to happen. You want to go in with your eyes wide open. You want to understand what you're getting, what the issues potentially are. You don't want to, go back after the fact and try to prove that this person didn't tell you this or that, or didn't show you this or that, or whatever else. That's not the way to approach it. So anyway, so go ahead.
No, of course. So we have Seth. He asked a question, but he kind of elaborated a bit more. He said, okay, so is this it? No, I'm sorry. He said, essentially, in the last deal, Bill was talking about, a receivable was already paid to the seller, but the buyer had to deliver the services. Was this deducted from the purchase price?
Oh yeah. So how do you resolve that? No, that's a great question. So, as conventionally, it's a working capital peg. The parties will say, you're going to deliver X dollar amount, in receivables and inventory minus payables at closing. If you're higher than that, you get more purchase price. If you're lower, we pay less for the business. So that's generally how it works. So the problem, with this deferred revenue, I'd call it, is that you're only going to be paid under that mechanism on how much the balance changes. So if the balance is the same, when you establish the peg as it is at closing, you're not going to get any compensation at all. And this could be millions of dollars. So how you have to deal with that is carve it out of the working capital peg and say, no, this isn't something that is subject to this peg. It's more like debt. It's more like, we're assuming an obligation here. And you would measure at closing, how much that is. And either the seller is going to have to leave that behind, in cash, that would be additional cash they'd have to leave behind. Or you'd have to come up with some type of negotiation. Sometimes I see people wanting to split profits on that, or, entitle the seller to a commission on that business or whatever else. There's a lot of ways to skin the cat, but you do obviously you need to have funding, for those services that you're going to wind up fulfilling, where the seller took the cash. So you need to get the issue on the table. As I said, the extreme would be that you just set aside the balance in cash. And I've actually seen that in published materials, believe it or not, for the fitness industry, believe it or not, where there are annual, dues in advance of sorts. Basically what their valuation formula says is, you're at 4 times EBITDA, minus, those that deferred revenue. That's how they value businesses, so it's routine in that industry that they look at it that way. So it's a purchase price deduct or cash left behind. Somehow you have to be compensated. Uh-oh, I disappeared. Here I am. Go ahead.
Nice, nice. So another one. Also, and any general comments on feasibility of earnouts for small middle market deals, $1 to $10 million deals, and supplier finance as part of the deal structure? So yeah, any comments on the feasibility of the earnouts? But and me particularly, I don't like earnouts just because in my experience, I'm paying the seller, I'm paying the bank. I paid the seller a large lump sum, right? Then we have seller financing. Then we have the bank to pay. Then we're going to pay another earnout. If the DSCR is not, at a certain number, it's going to decrease that with the earnout. That's from my experience. So I just would rather have earnouts on bigger deals, EBITDA in excess of 1 million, 1.5 million. Then we could, I would be more comfortable with EBITDA. With earnouts. What do you think?
Yeah. EBITDA is. Am I echoing? I'm sorry. Am I good? No,
you're good.
EBITDA. Earnouts have to stay within covenant in order to be paid. So that's the first thing. You're not going to be strapped for cash trying to pay one. So that's one thing. But I believe it or not, I mentioned in a white paper I did on inventory. I also did one on earnouts. So I'm happy to share. I also moderated a panel, just a few months ago for the Alliance of the AM&A, Alliance of Merger and Acquisition Advisors. I moderated a panel on it, and they're growing. I'm seeing them all over the place because of the pandemic, because of the uncertainty about valuation, and that could be uncertainty whether high or low. So, for example, a lot of companies in the online space, for example, had a big boom during the pandemic. Is that going to continue? That leads to an uncertainty in valuation, or obviously, the obvious conversely, companies that aren't doing well that expect to do well and come back. So a lot more earnouts. The Wall Street Journal claims it was up to like 50%, like double what it had been pre-pandemic. And I'm seeing them everywhere. They're just a way of dealing with the uncertainty that's out there now. And, if you've tried to look up multiples, for example, for industries lately, it's tough because there's just a lack of data out there. There haven't been that many transactions. Coming back now, but there's a reporting lag. There's actually a lot of activity now, but there's a reporting lag. So you're not going to find, and there's also inconsistency. An industry that I can really point to here that I've dealt with, pre-pandemic, was MROs for aircraft. These are the people that, do the maintenance. They were trading, if you had $1 million EBITDA business, you were trading 10 multiple on that. Like small businesses, like 10, 11, 12 multiples. That happened every day, all day long. Of course, the pandemic, these things went to zero. You can't sell them for any price. So how do you deal with that? How do you get a bank comfortable? How do you get yourself comfortable? And everyone knows, we're hoping it's going to come back, but is this business going to come back? This particular one you're trying to buy. So an earnout, for that type of scenario is really critical. And those are small companies, as I said. It's critical just to, for the seller to be happy that, they're going to potentially get the value that they think they deserve for the company.
Right.
So.
Yeah, it's definitely a lot of moving parts.
And then one thing you have to be careful of too with earnouts is the metric you use. I've been involved as an expert witness, believe it or not, in more than one earnout dispute. And the difficulty is that, you as a buyer look at EBITDA, adjusted EBITDA. You want the earnout to be based on that because that's how you're going to sell the business. That's how you bought it. That's how you're going to sell it. But the problem is there's a lot of nuances, involved in computing EBITDA. There's a lot of potential subjectivity and manipulation, all this other stuff. And I found when the earnout metric gets too complex, it inevitably leads to disputes, So you have to be careful on the metric you use. Something that would be safer to use, for example, would be revenue, sales, that type of thing, rather than get too complex, because that's going to inevitably lead to, problems. You have to be very careful.
Okay. So another one, John, he asked, how common is it for, how common is it, to ask owners to hold equity if anything turns up, we can deduct from their equity. Is this standard procedure? Is it advisable to reduce risk, of overpaying?
Yeah, that's a nice one. Because I do see that very often. I mean, whenever there's whether it's seller equity or a seller note, whatever you have out there that's due to the seller over a period of time, that's kind of a nice thing to have, especially if there's, explicitly a right of offset, if items are in dispute or whatever else. So absolutely is protection for you. You bet. I mean, the deferral gives you the ability to, to use those, to use it against those funds, even if you're just renting a building from the seller post close, there's potentially an ability to protect yourself, from issues that may come up that get uncovered. So,
okay. So I got an interesting one here from Seth again. He asks, is it possible / feasible to structure the deal without inventory and the seller retains inventory ownership? Then you purchase it from them as you use it.
Yes. and I gave that example earlier. No, that's what I call consignment. So in other words, yeah, absolutely, you can do that. And where I see that though normally is with slow moving or suspect inventory. People don't know whether it's really worth what the seller has it on the books for, and therefore, since they've relied on the financial statements they've been shown, they want a purchase price deduct. They want it's effectively an earnout, is what it is, but it's on an asset. It's an earnout on inventory. So, when that inventory performs, so to speak, I'll pay for it, but only then. So it's like, as I said, it's applying the same logic to inventory, making it consigned. Yeah, but no, I advocate people do that. I mean, I don't see it that often, but I have a deal going now where it's happening, and I've seen it, before. So it does happen.
Okay, so
I disappeared again.
Yeah, there you go.
I'm back. I'm back.
Okay, so just two more.
Sure.
All right, John. He asked one more time. What are some major red flags to look out for? / what are some common things that fraudsters owners would do to increase valuation in service-heavy businesses as opposed to asset-heavy businesses? So basically, what could the owners do, to fluff the numbers up when it's a service, based business that's not asset heavy?
Oh my gosh! Oh my gosh! Where to begin? Here's the issue, though. You also have to be careful. When I say fraudsters, I got to be very careful because there are gray area aggressive practices that I wouldn't point the finger and call fraud. You know what I mean? And that's what I encounter all the time, all day long.
Okay.
These are just, it's like someone trying to sell their house and telling you, I've got the best brick on this ever, something like that.
Right.
In other words, it's like it's aggressive, but it's not really trying to defraud anyone. So that's the first thing. But as far as, what I'd see in service businesses, oh my gosh, what not to see. I mean, there's revenue recognition's a big thing. Now, there's a whole change in revenue recognition in 2019. It became effective for closely held companies. It had already been effective for public companies, but it was a whole new thing which requires a lot of service businesses like consulting firms and even IT companies and contractors to do what's called percentage of completion. It used to be called percentage of completion accounting, which basically means your profits are based on estimates. So you are saying, yeah, I'm going to make X, gross profit margin. So as I incur costs, I'm going to recognize revenue pro rata with that. That is, subject to manipulation. I mean, that is the ultimate. Yeah, because you are recognizing revenue and EBITDA based on budgets. And so that's become the law of the land now because these new standards made it apply to many more industries.
Hey guys,
it used to just be construction contractors that did that, but now I've got marketing agencies, I've got IT companies, I've got all sorts of people that are doing this now, and the problem is when you're dealing with smaller businesses, they don't really have the systems to support it. I'm working on a deal now, where it's It happens to be a contractor, but basically, I looked at a couple of jobs, and they were showing hundreds of thousands of dollars in profit at the end of 2019, and then in 2020, when they closed out, there were like massive losses, in 2020 before they closed out. And I asked him, "Hey, what's going on here?" And he said, "Well, those are just guesstimates." And I'm like, if I were the buyer, and well, I am representing the buyer, trying to rely on this stuff. It's, oh my goodness, So I basically, again, I come up with alternatives. I mean, so I have also suggested that they use what's called completed contract accounting, where they defer everything until they're done and see what that would do to the statements. There are other ways to approach it, to look at it. So that's what I try and do. But as I said, the new accounting literature is saying that's what you have to do. Your repair business, you're supposed to do that. You name it, you're subject to it. So
perfect. All right. So last one for tonight. John asks, is EBITDA the best way to evaluate business, or just one of the more common ways? And would it be better to go more to the bottom line numbers like FCF?
I like that question, and what you'll find is, again, if you want to get my white paper, that's exactly the issue I address. We think alike. Because here's the thing. If there's generally the reason people can fall back on EBITDA is, when you've got sources like Deal Stats and the data is stable and voluminous, and you can go back to that and look at all the transactions and, see what happened. And wow, I got a pretty good idea from that, what the EBITDA multiple is. But when there's a pandemic, when people are closed down, when people are experiencing deficiencies versus windfalls, fewer transactions reported, and with the time lag that's involved, it's going to take a little while to catch that back up. What is reported is unstable, doesn't, even resemble what history used to be. Under those circumstances, what's a buyer to do? How do you become satisfied with valuation? And you basically have to go back to the basics, which is exactly what you're describing, the discounted cash flow. You build your own multiple. You look at the if you've ever studied valuation at all, there's a bunch of components, that go into building a multiple, basically, that you have to consider. You start with your risk-free rate, and, then there's the private company premium, and, all that stuff. And you rebuild it. You have to think hard. You do a discounted cash flow, you rebuild it. And that's what you have to do. If you want to get a reasonable number, and not only that, the seller is just as confused as you are, so sometimes you're going to have to have that, handy, just to be able to convince the seller that you're giving them a fair number, to be able to back up your position. Because, as I said, these days, for you to want a 10 multiple for your aircraft MRO, that's not going to work anymore. And that's what all the data used to say. I can tell you that. I read it. It doesn't say that now. So what are you going to do with that? You have to do the DCF. That's exactly, the direction it goes. You have to do, bring on the experts and, have them, chart it out and figure it out. So, yeah. And we have a valuation group at the firm. I'm not a valuation guy, by the way, but we do have a valuation group at the firm, that can help with that. So.
Perfect. Hey, Bill, as always, love when you're on, love your expertise and your insights.
All right, and I love you guys as well.
Bro, I appreciate it. Thank you very much. With you, we could do 101 episodes. Very knowledgeable.
Well, so thank you,
guys.
Gentlemen.
Feel free to reach out to Bill as always. You can't overwhelm him with deals. I've tried.
No, and I'm always happy to work with you guys. No worries. Yeah, no worries on that. I love to. And actually, I didn't even torture you with this, but I had sent you a calculation which I now has come to be known as EROC, and then I've got ERUA. So this is EBITDA, return on capital, and EBITDA or return on operating assets. So I actually did an article about that, exactly the metrics that I kind of coined those metrics working with you guys, believe it or not. So I will threaten to send you that article now. So
nice.
Yeah, I got the white paper now.
Guys. So reach out to Bill. As you can see, expertise is just on a whole different level, and he's the guy you want if you don't want to overpay by hundreds of thousands, possibly more. So if you want someone who's going to look at your deals with over 20 years experience, who is a vet in this game. Bill Wiersema is your guy. Again, Bill, really appreciate you being on. I'm definitely going to have you on. I want to bring you on for another episode so we can discuss some other things. Like you talked about some of the formulas and stuff like that,
Yeah, love to.
the inventory stuff more in depth, but until then, appreciate you, Bill.
Very good, gentlemen. Thanks
Thank
so
you very much,
everyone.
Bill. Have a good night.
Thanks for the
Take care.
opportunity. Take care.
Absolutely. Bye.